Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. All right, welcome everyone. Today we're going to dive into a pretty interesting and sometimes tricky part of Canadian tax law. We're talking about the tax on specified investment flow-through partnerships. You'll hear me call them SIFT partnerships. Our goal here is to really demystify how this tax is calculated, and we're going to do it step by step. So here's our plan. We'll start with the what and why of SIFT tax. Then we'll get right into the core formula. After that, we'll test it out with 3 different scenarios, starting simple and then adding some complexity. And we'll finish up by explaining something called the deemed dividend, which is super important for the partners in these SIFTs. Sound good? Let's get started. Okay, so first things first, what is this SIFT tax? Well, think of it as a special rule found in Part 9.1 of the Income Tax Act that targets these specific partnerships. The whole idea is to treat the SIFT's income as if it were earned by a corporation. This means the partnership itself pays the tax. Now, this reduces the income that flows out to the partners, but, and this is the really clever part, it recharacterizes that income. It changes it into something called a deemed dividend, and we'll see why that's so important later on. All right, let's get down to the nuts and bolts. To really see how this all works in practice, we've got to look at the core formula. This comes straight from the CRA, and believe me, it's the key that unlocks every single calculation we're going to do today. And here it is, the master formula. A times the sum of B plus C. I know, it looks pretty simple on the surface, right? But the real magic, the real nuance, is hidden inside each of those variables. So let's pull them apart and look at each component one by one. First up, we have variable A. This is what we call the taxable non-portfolio earnings, or TNPE for short. You can just think of this as the core business income, the main earnings of the partnership that this special tax applies to. Everything starts here. This is our base number for the whole calculation. Next, we've got variable B. This is the net corporate income tax rate. In simple terms, it's the federal government's share of the tax. For our purposes, we're going to use the general federal rate of 15%. And just to make things easy, this number is going to be our constant. It won't change in any of our scenarios today. And that brings us to variable C. This is the provincial or territorial SIFT tax rate. Now, this is where things get interesting. This is the moving part of our equation. Its value is completely dependent on where the partnership has what's called a permanent establishment, basically where it's doing business. And as you're about to see, this can be a single rate, a special default rate, or even a blend of different rates. Okay, enough with the theory, right? Let's put this formula to work. For our first scenario, we're going to look at a SIFT partnership that has a business presence, a permanent establishment, but it's only located outside of Canada. No provincial ties at all. So here are the numbers we're working with. Let's assume the partnership's taxable non-portfolio earnings, that's our variable A, remember, is a nice round $1 million. The federal rate, variable B, is our constant 15%. Now here's the key for this scenario. Because there's no PE in any province, a special rule kicks in. Variable C gets set at a flat 10%. Simple as that. So let's plug those numbers in. It's actually really straightforward here. We take our $1 million in earnings and we multiply it by the sum of our 2 rates. That's the 15% federal rate plus the special 10% rate for having no provincial establishment. Add those together and you get a total combined tax rate of 25%. So 25% of $1 million is, you guessed it, $250,000. That's our total SIFT tax payable. Think of this as our starting point, our baseline. Now let's make things a bit more realistic and see what happens when we bring a province into the mix. All right, on to scenario 2. What happens when the partnership's business is entirely based in just one Canadian province? For example, let's say that province is Ontario. Okay, some of our assumptions are staying the same. We still have $1 million in TNPE, and our federal rate is still 15%. The big change, the key difference here, is variable C. Since all the business is in Ontario, we don't use that 10% default rate anymore. Instead, we use Ontario's actual general corporate income tax rate, which is 11.5%. So the math here is pretty direct. We just add the federal rate of 15% to the Ontario rate of 11.5%. That gives us a new total tax rate of 26.5%. And if we break that down, applying it to our $1 million, that's $150,000 for the federal part and $115,000 for the Ontario part. And there's our final number, $265,000.
See the difference? This really shows you the direct impact of having that provincial establishment. The total tax is $15,000 higher than our first scenario, and it's all because Ontario's tax rate of 11.5% is higher than that default 10% rate. It's that simple.
Okay, time for our final and most complex scenario. This is where it gets really interesting. We're now dealing with a partnership that's operating in multiple places at once. It has a presence in Ontario, another in Manitoba, and it's earning some income from outside Canada too. Now, for a case like this, how the income is allocated is absolutely everything. The total TNPE is still $1 million, but look how it's broken down. $600,000 is earned in Ontario, $250,000 is earned in Manitoba, and that leaves the last $150,000 earned outside of any province. Because Ontario and Manitoba have different tax rates, we can't just pick one. We need to calculate a special blended rate. So how do we get this blended rate for our variable C? Well, we calculate a weighted average. It's a few steps, but they're logical. Step 1, we look at Ontario. It accounts for $600,000 of the million, that's 60% of the income. We multiply that 60% by Ontario's 11.5% tax rate, which gives us 6.9%. Step 2, we do the same for Manitoba. It's $250,000, or 25% of the income. We multiply that by Manitoba's 12% rate, and that gives us 3%. Step 3, don't forget the income from outside Canada. That was $150,000, or 15% of the total. We multiply that by our old friend, the default 10% rate, which adds another 1.5%. And the final step, we just add up those three weighted pieces. 6.9 plus 3 plus 1.5 gives us our grand total blended rate of 11.4%. So now we have our custom-built variable C. And what's cool is that we can now plug it right back into our simple master formula. The total tax rate is our constant 15% federal rate, plus the 11.4% blended provincial rate we just worked so hard to calculate. Add them up, and we get a combined rate of 26.4%. And so when we apply that 26.4% rate to our $1 million of earnings, the final SIFT tax payable for this complex multi-jurisdictional partnership comes out to $264,000. Okay, so we've gotten really good at calculating the tax that the partnership has to pay. But honestly, that's only half the story. The whole reason this tax exists is to change what the partners get at the end of the day. So now we have to ask, what does this actually mean for them? And that brings us to the million-dollar question, doesn't it? After the SIFT partnership pays all this tax, what's actually left for the partners? And what form does it take when it hits their hands? Believe it or not, the calculation here is the easy part. Let's just go back to our first scenario for a simple example. We started with $1 million of earnings. The partnership paid $250,000 in SIFT tax, so what's left? $750,000. That's what's available to be distributed. But here's the crucial point. This isn't just regular partnership income anymore. The law deems this amount to be a dividend, specifically an eligible dividend, as if it came from a regular Canadian corporation. And why does that matter so much? Because eligible dividends get much better tax treatment for individual investors, thanks to the dividend tax credit. So you see the whole picture now. The partnership pays tax at a corporate-like rate, and in exchange, the partners receive the after-tax income in a much more tax-efficient form. That right there, that integration is the entire philosophy behind the SIFT tax rules.